Most business owners want to grow faster, but the problem is they don't have enough cash to do it. So if you're a business owner that's struggling with getting enough cash to grow the business to the level that you want or to the speed that you want, this video is for you. Hi, my name is Morgan Whalen. I'm a fractional CFO and I work with small business owners every single day on problems just like this. So let's go ahead and get started and figure out different ways that we can accelerate the cash flow in your business. Here's the thing. Your business, it doesn't grow from revenue. Your business grows from cash, right? If you have enough cash, you can open up a new storefront, you can hire more people, you can spend more on your advertising or marketing, right? Everything becomes a lot easier if you have more cash to do it. But the problem is most businesses start getting cash constrained as they grow. And it's not their fault. They just don't understand how money works and how money flows. And so if money takes too long to come back to you, you can't reinvest it, you can't hire, and you can't scale. That's the problem that you're gonna run into really quick. So this is what it could look like. Like your revenue could still be going up, but your cash flow, which is here in red, could be stagnant, or if anything, it could be going down over time. And so if you're running into this issue, you're in the right place, and we're going to talk about how you can solve that today. So here's what this looks like. So as you are going through your business, what ends up happening is you have this cash conversion cycle where you spend money here on sales and marketing, and then you're going to get leads, and then the leads go through the sales cycle, and then so many of them convert into paying customers, and then you deliver services, and then you invoice the clients for the work that you provided, and then you get paid, right? So this is the whole cycle. Now the goal is, how can we shorten the time between when we spent the money over here and when we get paid over here? That's the question. How can we tighten this up? All right, so let's go ahead and look at this example. So in here, we have a 10K service for a single client, right? And so the client signs 5 days beforehand, which is now today, and then you're going to spend $6,000 as the business owner to then deliver the good or the service, right? This could be in material, this could be in labor, in other costs right here, right? For the 30 days or 29 days. And then the service is going to be complete. The invoice will be sent. And then 60 days after you started, you're going to get paid $10,000, right? So in order to even take on a customer, you have to front at least $6,000 each time. So that's money out of your business's pocket in order to deliver on the good or service. And we're not even talking about acquiring. So let's say that's an extra 1K to acquire the customer. So you're already at 7,000 in the hole negative by the day 30, but then it's going to take you to day 60 to get 10 grand back. So what's that going to do? If you always have this delay between when you're spending money and when you're getting it back, very shortly, you're going to start running to a problem where you have less and less cash. So if you had, $15,000 cash, well, when you run through one cycle of this, well, okay, so I spent 7, got it, so 7, so now I have 8K left. And then I either have to wait to collect the 10K, which is 30 days, or I could spend the 8K that I have left remaining in the bank to go get another one, but then I'll only have 1K left until 30 days pass, and then I'll get the 10K back in return. So you can see how you're slowly going to whittle down your cash. It's going to start looking like that over time when you have this setup. And so you're like, okay, well, if it's just one, it's not that bad. But what happens if you had 10 clients, right? If you scaled operations the way this is currently laid out, you're going to be floating over $60,000 from day 0 to 29 just in the delivery cost. Okay, that's not to acquire a cost, right? So if you did back to that example of 1K per acquisition, that's actually 70K that you're floating at one time. And then eventually 30 days after, you're going to get 100K back, right? So you can see how this becomes a really big issue, and cash can become your constraint in your business to grow it very quickly. So what do we do? Well, we need to find the leak. So whether it be your sales process or your sales and marketing process here, it could be something like your close rate. It could be like you're taking on a whole bunch of leads and you have a lot of volume, but not a lot of them convert because you're not qualifying the leads to the way that you to the level that you need to. It could be in the delivery time, right? You could have missed timelines because you thought a project would take 10 days, but really it took you 15 days because of these factors that you weren't taking into consideration. And so that elongates the whole cycle. Uh, or you could be over customizing your work to every single business or person that you do business with. And so you have no way to systematize what you do. You could be doing late invoicing or no payment terms on the invoices that you send out. Again, slow payments, no fees for late payments. These are all holes that are causing you to elongate your cycle between when you pay cash out in expenses to when you get cash back from customers paying you. So again, how can we compress this down? So that's what we're going to look at. So one of the biggest delays as you're looking at your process, as you're looking at where the leak might be coming from, this is just a side note here, right? It can apply to any department or process that you have in your business, is deciding what to do. So a lot of times when you have a team, they may not be sure, do I do A or do I do B or do I do C in this scenario? And so having checklists or standard operating procedures can reduce the amount of time that they are spending trying to think, what do I need to do? And they just go into action more. So the more decisions that you can remove, the faster your cycle can run. So as you implement a team, the less decision making they have at these levels, and the more they're just following the process, the better it is. And so this is the ideal. You want to, you have a certain amount of work time and you have a certain amount of decision time for each employee or worker, and you want to try to shift this over time. So that's just one example of what it can be. So you need to spot the bottlenecks in your business and fix the cash flow holes or the leaky holes that you're experiencing. So how do we shrink it? I'm not going to say, hey, go figure it out on your own. I'm going to give you some examples here so we can maybe point you in the right direction on what to look for. And so there's really two main levers. There's operational efficiency levers, and then there's the model that you're using in your business. So we're going to talk about operational efficiency first and then move over to the model second. So really, this is time. We're trying to shrink the time between, again, spend and return. And this one could be like improving the sales process. So we can go to pre-qualifying our leads. We can try to go to a faster close cycle. So let's say your sales cycle right now is 20 days. Can we somehow get it to 15 days, right? Every day less in the cycle, better. Same thing with delivery. Can we go from 30 days to deliver to 25 days to deliver? Because every single day less, you can shorten your cycle, all right? Conversion rate optimization. So this could be something as well. If you're doing online, then it could be testing different headlines or seeing what people opt in for as far as whatever it is that you're giving away, or the form that you're using to have them fill out. Okay, so that's one, improve the sales process. Two, we can compress the delivery time. So this is on your deliverables. Well, how do we do that? We use templates, SOPs, we train the team, we do less custom work, or maybe we just cut down overall like what we're offering instead of doing all these other things to say, okay, these are the ones that get us the fastest time and we know we can get really good at, and we're just going to focus on these and that's it. Okay, so that's from a delivery standpoint. And then from a billing and invoicing standpoint and collecting cash, we can look at, okay, how do we accelerate our accounts receivable or what people owe us? Okay, so how can we get more deposits? Can we shorten up our nets, which means when the invoice is due? So if you say, okay, I'm sending you the invoice today and it's net 30, it means that you have 30 days to pay this invoice. Well, can we reduce that to net 15 or net 10 or net 5, right? So maybe if you have a way of working in business where it's 30 or your industry standard is 30, maybe you just slowly start creeping it in over time, right? So you want to try to send out automated reminders too, and then give incentives if you want to get early pay discounts. And so if you send out a reminder, maybe 2 times a week, then they're more likely to pay it sooner or keep it top of mind for them. All right. Another thing is extending accounts payable. So, try to get better vendor terms, and you want to keep cash longer. So that's another way. If you can keep cash longer, you can use it inside your business before then you have to spend it on your vendor. So if you can figure out ways to extend how long it takes for you to pay them, that's even better for your business. Reducing your inventory. So if you have a lot of inventory, if you carry inventory in your business, then look at how long does it take for your inventory to turn over, right? So we can get 5 turnovers in a year. That's great. Can we get it to 7, right? And that may be reducing the amount of products that you have and just looking at sales velocity, which are our highest selling items, and maybe only stock those and start getting rid of all the other ones or putting it on your online shop And so they have to order online for those. But in an in-store, it's just your highest selling, most popular items. And then you can automate. So again, billing, follow-ups for sales process. A lot of admin work can now be replaced with automation or AI between those two things. So that could definitely save you a lot of time. If someone does something and you can instantly send something back, that speeds up the process, right? There's no lag time in between something happening and then the internal team doing work, between something happening. Let's say a lead submits a form and you instantly give them a response, or you instantly give them that thing that they were looking for. Okay, so reducing lag time is great. So any ways that you can compress the cycles between your sales and marketing, between your delivery, between your billing and invoicing, or even your inventory, right? All those condense the amount of time, and it speeds up the or accelerates the cash conversion cycle. Okay, so these are the levers that you can use without changing like what it is that you're selling, right? Without changing anything about the model. So then the other one is the model. So this is the how and the when. So in here, you can change your terms on cash collected. So you could say, hey, I need this much up front before I start the project or the work. And then I need this much at this point, and then I'll finish it off right when the project's complete with the last payment, rather than saying, I'm going to wait for the project to be complete and then I'll bill you, right? So if you can pull that money forward, better, because now you're pulling your billing cycle inside or right next to your delivery cycle. So instead of them sitting on opposite ends, right? So you have sales, then you have delivery, then you have billing. But if you could take that and move it at the same time as delivery, well, now you just shorten the whole cycle overall, right? So that's a great way to do things. So it's like, how can we look for ways to condense these cycles down tighter, so then that way we can get our money back quicker to then get more customers. So you can see how we're going here, what the idea and the strategy is. So it could be deposits, retainers, milestone billing. It could be switching to a recurring revenue model, right? So in the same concept, so sales, delivery, and then you have billing. So then it just becomes like a loop here. So you have that, and then it loops back around. And then so then you're going to have 2 points right when they come in with sales, right? Then they may pay here, and then they loop back around and they keep on paying, keep on paying. Okay. All right. So then I hinted at this one earlier, but another one you could do is you could change your offer, right? The offer is one of the highest leverage things that you could do in your business. And you could change it to say, okay, we're going to be more productized, meaning we're going to offer just a set base of things for our service, and that's it, right? Anything outside of that, we're not going to touch. Again, you want to move away from that customization, or we solve all of your problems, right? We're the one-stop shop for all of your problems, and just say, hey, we only solve these services. Because once you say, okay, this is our boundary, this is our scope, you can get really, really good at iterating and becoming better at delivering that service. So as you gain more efficiency there, you'll cut down your costs. And then you can also remove high cost, low value items. So if you have a package of things that you sell, let's say you sell services and you say, I do these 5 things. Well, if one of those 5 things is a high cost to you for delivery, meaning your time or your team's time, but the customer doesn't really value it that much, or they're like, I don't really even need it, then you can just get rid of it altogether, right? Then you only sell 4 things, and it makes it cheaper for you to fulfill, and then you save more costs. So, and then you can also shift your client mix. Again, this is going back to who you want to work with. So you want to try to find clients who pay fast and require less overhead. So if you had a choice between someone who requires a lot from your team and your support, and they ask a lot of questions and all that stuff, versus someone who is a very good client as you define it, then you maybe want to try to find and filter for more of these and less of these, right? So these are the levers that change the rules of the game, right, for the model. So then that way the cash flow works better in your favor. So if you can bring cash forward a lot of times, and when you're billing, that will help you recoup your cost and then be able to spend more down the line. So I want to point out just 3 powerful levers. There's many in your business, but I just want to point out 3 for you. So one is speed, and we've talked about this over and over again. Speed is so, so important. If you can, again, condense your cycle, you can run the cycle more times through than someone else, a competitor in your same industry. So how does this work? Well, if you can take your cycle time from 60 days now to 30, well, what does that do? You can do twice the amount of work. You can reinvest the same amount of cash twice as often, and then you can leverage without having new capital needed. So what does that look like? So in this table, right, you have a 60-day cycle and a 30-day cycle, meaning they could do 6 cycles per year, while this other company has gotten the efficiencies, kind of talked about what we did about condensing the cycle or maybe change the model a little bit. And so now they could do 12 cycles a year. Okay, so total revenue over here would be $12,000, and over here it'd be $24,000. And so then, you're looking at this and you're like, oh, okay, I would much rather be over here on the 30-day cycle. It's because you can use your cash more often, and so you can run the same playbook more times in a given year and get you more profit as a result and more revenue. So why not do that if all else being equal, right? So that's the real key here in condensing your cycle time. So if you have the same team, you have the same offer and the same cost basis, then faster cash flow just means double the output and double the profit. All right. So then the second lever is gross margin. So what does gross margin mean, or gross profit? It really means the price at which you sell something at minus your cost to deliver. That's your gross margin. Okay. So how much is left after delivering your product or your service? And so if you're moving fast, but your margins are thin, you're still going to run out of cash. So this is one of the most important metrics you could ever track in your business. And I have a whole video on it. You could check it out above. But essentially, you want to always keep an eye on your gross margin. And so you want to figure out ways to increase your margin so you have more usable cash per sale, right? So how can we, streamline our team? So let's just say you have a team of 4 that can serve 10 clients. Okay, can we have 3 people serve 10 clients, right? Or can we have the 4 people serve 15 clients, right? And so you want to look for that, for team efficiencies that you can have. You want to look for, again, higher margin offers. So going back to that example of you offer these 5 features and you take one away, okay, well, that will free up your team. So now they can serve the 15 clients, and then you only deliver on 4 things. So you can get more efficient at just serving and providing those 4 things instead of 5. And then reducing fulfillment costs overall. Now, in most companies, if you look at fulfillment costs, there's a part that passes through, meaning like if you buy materials, let's say your construction, the cost of materials you really can't control unless you're a really, really big company and you can work with vendors and buy at discount prices, right? But for the most part, you can't control those prices. You pay what you got to pay. So the first level of control for you and your business is your contract labor and your direct labor cost. And so then you definitely want to look at those costs that you can control and say, how can we do this? And it may be saying, okay, well, we have someone whose time is $50 the hour working on something that someone with $20 the hour should be doing, right? So it could be understanding at the task level, like what's being done, and reorganizing things to make sure only like what is required from that higher level person. Those are the only tasks that they're doing, and everything else is offloaded to a team member that is costing them less per hour. All right, and so the third lever that I wanted to speak on was pricing, because this is the biggest lever that you can pull. And I'm going to show you this in an example really easily. So let's say you sell your services for, like $100 the hour, and it costs you $50 to deliver because you have someone on your team, you pay them $50, you keep $50 as the business, right? So your gross margin's 50%. So 50% margin, you sell 100 units of someone's time, and so that's $5,000 in profits, gross margin profits, or gross profits for the business, and it's costing you $5,000, or the other person makes $5,000, okay? So let's say everything else stays the same and the only thing that changes is your price. What happens? Okay, so if you raise your prices by 5%, so now the new price per hour of time is $105. The costs stay the same, you still pay them the same. So now the profit per unit is $55, and so you made $5,500 for the same amount of work. So what does that actually translate to with a 5% increase in profits? Or sorry, a 5% increase in price. That's a 10% increase in profits without more clients, more work, or more delivery costs. So this pricing is such a huge, huge, huge lever. And so I always encourage business owners to look, because inflation goes up every single year. So you should be adjusting your prices theoretically every single year. The cost of wages typically go up every single year. So you should be increasing your prices every single year. So if you're not doing this, this is an easy way that you can put an extra 5, 10, 15% profit straight to your bottom line. Okay. I don't know of any other lever that you could do it that simply. Okay. So it is the highest leverage move that you can make. And so my final thoughts here is just remember your revenue is really and your P&L is really the scorecard. And so that's telling you how well you're doing things. Same thing with like your cash flow here. And so your cash flow is your oxygen. It allows you to move at a certain speed for your business. If you have more cash, you can grow quicker. If you have less cash, then you become cash constrained. And so the whole goal here is to shorten your cycle. And I've given you those examples. So figure out how you can apply that to your business. Fix your model by maybe removing some things from what you offer, or by charging more up front, or changing how you invoice and collect payments. Things like that are really, really important. Another one too is like if you do reoccurring, and this is just a side note, if you do reoccurring, then you can keep their card on file and they get billed automatically. So you don't have to worry about chasing them down for payments. And then the idea here is you can get control of your cash. So if you can get control of your cash, you can get control of your growth. And if you can get control of your growth, the sky's the limit. So hopefully you found this insightful. Let me know down in the comments below what you're going to be trying first in your business. And if you have questions, let me know as well. But don't forget to like and subscribe, and I'll catch you on the next one.